More on the jobs numbers. Dan Heckman joins us. He's the National Investment Consultant at U.S. Bank Wealth Management. Welcome to the show. Good to see you. 280,000 jobs. The markets ended the day mixed on it. So where do we stand? Are you happy or sad?
I think it was a fantastic report, Philip. The market reaction is not too surprising. I think it caused some fears that the Fed may finally raise the Fed funds rate. But in reality, when you look at it from solely the economic perspective, across the board, this was a very good report.
What about the rates? A lot of people are talking about how mortgage rates have bounced up, long-term rates have bounced up. In other words, it seems to me that investors are getting ready for a potential rate hike, but it doesn't seem like anybody's really surprised about it either.
No, I think this has been so well advertised. And, you know, this was the type of report that I think gets the Fed off the dime, makes them really consider in the next month or two. They may want one more report. They get that for June, something similar to this report in terms of the strength of the numbers of jobs created. I think what really the Fed is looking at in this number that came out this morning was the fact that hourly earnings were up 0.3%. That is the best since we've seen since the financial crisis. And I think the Fed really wants that labor market to tighten up so they see these wage gains come out in a very consistent month-to-month basis.
I was being interviewed on another show about these jobs figures, and I had to explain why the bump up of the unemployment rate to 5.5% is a good thing. It was a little bit counterintuitive. Maybe you could help us explain why is that possibly a good thing to see the unemployment rate go up?
It was actually a great thing. I agree with you, Philip. And the reason being is that it came in conjunction with the participation rate going up 0.1%. I think if you dig down underneath the numbers a little bit as well, you're going to see that the long-term unemployed also dropped 23,000. And when you look at the last few months, about last 3 or 4 months, it's dropped a total of 300,000. So that's a real indication, in our opinion, that the labor participation rate, the labor pool is expanding. We'd actually like to see the unemployment rate rise slightly. We don't think it will go much above 5.6, but that labor market participation rate, we want to see expand, the labor pool expand, long-term unemployed continue to drop very precipitously. We think this is a very, very positive report.
Dan, hang on a second, because the last couple of these reports, experts were telling me they didn't want the economy to be too strong because they didn't want the Fed to be raising rates. This time around, the numbers are better than expected, showing that the economy is perhaps stronger than expected, but the reaction seems different. And I'm trying to understand why.
Well, I think, you know, a lot of it has already been built in the expectation. And I think what we all forget, including professionals, my peers, let's keep this in context. In reality, we're talking about only 25 basis points. We all know that's what the Fed will do. They'll probably do it only one more increment at best, maybe perhaps in 2015. The pace of these Fed funds rate increases are going to be very slow, very methodical, data dependent. The Fed has told us this for months now. And I think the market has really anticipated and built that already in.
All right. I'll leave it at that. Have a good weekend. Thanks for spending a few minutes with us explaining these numbers.